Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's episode is sponsored by Building Insurance and Risk. When you invest in real estate, work with the experts at Building Insurance and Risk. You will receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Spencer Hilligoss. Spencer is the CEO and co-founder of Madison Investing, a real estate investment firm specializing in real estate syndications. As a passive investor and active syndicator, he understands the unique challenges that busy professionals face when starting out in their real estate investing journey. Spencer's mission is to arm investors with the know-how they need to make confident investment decisions tailored to their individual life goals. Prior to pivoting to real estate, Spencer held several executive roles in the financial technology industry, including positions at Intuit and Gusto, forging a 13-year track record of building high-performing teams across 5 companies, 3 of which are valued at over $1 billion. Throughout his career, one thing has remained consistent: his ability to keenly focus on professional development, helping teams and individuals reach their full potential. Spencer is a member of the 2021 Forbes Real Estate Council and has been featured in publications such as Business Insider. When he's not shifting the way people think about investing, you can find him listening to metal, adding to his tattoo collection, and jogging through the Bay Area with his wife and 2 sons. Ask him about the time he played on stage in San Francisco at the Vans Warped Tour. And in just a minute, we're going to speak with Spencer about playing financial offense versus defense. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guests. Spencer Hilligoss, welcome to CRE PN Radio.
Darren, thank you so much. This is a wonderful way to start the day with you. So really great to connect.
Well, I'm glad you're here and I'm looking forward to our talk. Before we get started, if you could take just a minute to share with the listeners a little bit about your background.
Yeah, happy to. So as you mentioned, I'm out here in little island city called Alameda, and it's in Silicon Valley. It's actually right across from San Francisco and kind of tucked next to Oakland, for those that don't know that name drop. I wake up every day feeling kind of blessed and pinch myself right now because I get to serve the passive investors in our passive investing group we have at MadisonInvesting.com. And that's something 25, 30 years ago, if I could go back in time, Darren, and say to myself, hey, you're eventually going to be running an investing group in a private equity firm that helps people invest passively and de-risks it for them a bit, I'd probably look at myself thinking I'm crazy because I grew up in a real estate business working for my dad. He was a residential real estate broker for 30 years. I used to be embarrassed to say that because friends are working at tech companies as they kind of got into high school and beyond, and telling them I worked in my dad's real estate business was not exactly the cool thing to be doing, let alone working at open houses, instead of going and hanging out with friends, clearing out fridges for properties that had to get prepared for sale. Not very glamorous. So I did that, and it really scared me into technology. So I ended up getting into tech companies, and I was there, as you mentioned, in that really thoughtful intro. I was in that for 13 years, and I cherished it. I really did. I think a lot of folks in the real estate investing community, bless their hearts, they tend to dig and critique the corporate world and the W-2 world, and that just wasn't my experience. I mean, I frankly had a very positive experience. There was times of immense challenge, Of course, specifically when you're leading and managing large groups of people. But all that to say, I ended up realizing and having some really key moments of decision alongside my wife, and who's also my COO, Jennifer. We had gotten to that point with great incomes, working, dual income household, and investing and maxing out our 401ks at the time, a couple of young kids. And there was some key moments where light bulbs went off for me after I joined a real estate tech company eventually. And I saw how well some of these investors on the other sides of these deals we were lending money to at a lender, I saw how well they were doing, and it really lit the spark for me. And I realized, oh, we can invest for this thing called cash flow and not just park our money in something that, we are not going to be able to touch for 30 years without a penalty. So what happens when we do a bunch of these investments over time? And that's really, the kind of the tip of the iceberg for what led us to actually doing this full time and helping hundreds of people that now invest with us basically get in and get the memo earlier than I did. If I could go back in time and kind of figuratively shake myself by the shoulders and say, hey, dude, you can go there and do this differently. There's a better way to go and invest because you can change your life. And about 5 years ago, we set a goal for 15 years. We wanted to be financially independent. We chopped that goal in half, and then we had to whittle it down again because we had achieved it. And now we're just very grateful to wake up and help other people, walk that same path today.
Well, I love the story there. That's quite a fascinating journey. From the tech and kind of resenting your dad kind of thing, or at least not being really excited about the real estate the way you were had experienced it, but then seeing the aha when you were looking or working with investors and kind of catching the bug kind of thing. So tell me something. You mentioned 5 years ago. When did you start investing? Were you and did you start passively? And then you said, was it 5 years ago? I guess give me a little bit more definition on the timeline as to when you first invested as opposed to when you started.
Well, we went through these. Oh, sorry. I didn't mean to cut you off.
No, I just wanted just for clarity on the when you started doing your own syndications.
Yeah, I appreciate you taking it there. I think there's 3 phases to it. Of course, I package it in 3 phases with Jennifer now because in hindsight, everything in life tends to be quite a bit clearer, right? And hindsight 2020, as they say. At the time, it felt like navigating a maze and, trying to figuratively grab a machete and just hack through every challenge and learning and mistake. And that's just how learning tough new things goes. So we started off in 2016. I mean, we'd already, bought a home, of course, but we're, so many folks would call that an investment, but that started all the way back in 2013. Buying a home in the Bay Area is not something that is easy to do. As you know, Darren, it's like a pretty scary, massive price tag. And around 2016, I was working for this tech company that actually was also working with real estate investors, and that's where I got that bug. Exactly, I think you said it well. I caught the bug. And I read, like no joke, I read 24 books on finance and investing in real estate in 18 months. I listened to 400 podcasts that provided a wonderful foundation of knowledge, just like yours. And I think that I didn't need to do that much education. I think some of that became procrastination before we finally went out and bought a duplex. We still own this duplex now. It was our first real investment property. It cost us $430,000. And, that's Bay Area pricing. Thankfully, it's appreciated quite a bit, but it was producing $200 a month in cash flow. And that's already a miracle in California from what we now know. But that said, that property took over $100,000 in cash because, of course, you get a loan on it. And that's as much depth as I'm going to give people, but that's an important learning because that's what scares most people and they stop. And it almost scared us because we realized we can't keep doing this. We had some capital we'd built up from our jobs, but we couldn't necessarily go out and do that over and over. We need our dollars to go further for us. And so phase 1 was just buying that, going through those learnings, using a whole summer just to find that one property with our infant son in the car. It was not easy. Phase 2, found the courage to look outside of California, outside our local market, buy long distance rental ownership. We got up to 5 single family homes in Kansas City, Missouri, and different economics, that's for sure, makes people on the West Coast look at these with confusion and excitement, and equal parts of both. Price tags, purchase price, $60,000 per property, and roughly $250 a month in cash flow. And if I know your listeners probably know this, but just to make it clear, that means after everything else, that means after taxes, mortgage, insurance, all the rest. And so all of that, $250 a month sounded great. But phase 2, as we called it, in that long distance rental ownership phase, was really about learning, well, rentals are semi-passive at best, even with a property manager. And I strongly believe in property managers and hiring them for that 10% or more, or depending on how many you have. Most people are going to be paying at least that, but you still have to manage the darn manager. And if you own rentals far away, oftentimes you're buying them in neighborhoods. We would probably call those C-class neighborhoods. So you've got higher turnover. So what happens when one of those properties goes from 100% occupied to 0% occupied, because it's a single family home overnight, and all the costs associated with that wiped out that $250 a month for the whole year from one of them, right? So that phase really was about learning, and thankfully we got out at a profit. And we went into phase 3 because we had to find something that was more passive. And 2 young kids, full careers at that time still, but that's when we were still like in parallel owning those properties, but we had already started putting money into syndications, and so price tag on those, you're putting a minimum of $25,000 or maybe $50,000. And so our first one was 25, and that's LP investing, or limited partner investing, AKA being a passive investor in syndications, and so that's when my colleagues and my coworkers in my day job, they started asking, like, what are you putting your money in? I thought you guys were just building this big rental portfolio. And I shared my enthusiasm for what we had landed on, because I'm an operations guy by trade, Darren. So like building teams and forecasting, I like predictability. And I just couldn't get away from those economics of, well, single family home that we owned, occupancy goes from 100% to 0 overnight if a person has to leave. 400 unit apartment building. Well, we certainly can't buy that ourselves, but there's these other structures that people can do where you can own a piece of it. And as long as you get over the ego hit of that, which a lot of people get stuck on because they want it to be quote unquote mine, right? But we got over that and realized if we just invest that, we have to do diligence on the front to trust this other team, these other humans. And that's the biggest risk on these, of course, getting the right teams. And that's why we built a business around it, is we felt like we built such a clear, strong 5-part framework to do that for our own money. People were asking for us to help them go and figure this out for themselves so they could start that journey. And lo and behold, there we are in 2022. And now we've done 37 of those deals as Madison Investing. So and 13 full cycle exits of properties going all the way to completion and sale at the other end. So it's really been quite a journey, but that's probably more than you wanted.
No, actually, I appreciate the kind of the detail, because I was definitely curious about how you got started and kind of the 3 phases, but more the syndication, and how I think the thing that I appreciate the most is how you mentioned and referenced the kind of the ego thing, and that when you're going alone, it's all yours. But if it goes to 0, it's all yours too, right?
That's right.
Whereas if you get a teammate, or you become a part of a team, you can smooth out those ups and downs and be more passive if you like to be, and the returns are more predictable. And I'm kind of curious, as you said 37 syndications, 37 that you've invested in, or have you been the GP on any of those, or where are you at on?
Yeah, the 37 was actually not, some of those we also invest in, because we do invest as part of our vetting framework that we commit to 100% of our investors 100% of the time. So we always put money in with the asset management teams that I end up joining in the GP with. on our active deals. And so those 37 are purely our active deals, which the majority of which are apartments, syndications, self-storage. We also do self-storage. Those are my two areas of expertise that I try to stay in my swim lane on, because I feel like that's always just a guiding, helpful principle in general for great investing and just life, which is stick to the stuff that, when the stakes are high, stick to what you know. But we also occasionally work on niche stuff that's non-real estate, but that's really once in a blue moon. And so other than that, we will do fund models. So sometimes we're just wrapping up a fund, which is really just the same economics, honestly, for the investors and anyone participating. But there's 7 apartment buildings throughout the Southeast between Georgia and Florida, compared to one syndication apartment in the same kind of market.
No, and that's kind of another level of opportunity. But going to the syndication. So if I understand right, so are you a GP on any of the properties, or have you created more of like an investment vehicle to where you're raising money to invest in other investor led properties, or are you the principal on any of those?
So by design, there was this moment many years ago when we formed Madison Investing, Darren, where, a mentor of mine was like, we're trying to carve out the strategy, like what role do we want to play? Because this is where, honestly, I think 99.9% of aspiring active people in real estate, unfortunately, make a major misstep, and they try to fly through this key moment. And we sat there, looked at our experiences, asked, what are we really great at? Where can we add value? And did we want to go out and become, the next big apartment owner and compete with people in the single most competitive landscape of commercial real estate and real estate history in general? Well, no. Also, I can't swing a hammer. I'm really good at, what am I good at? I'm good at partnerships. I'm good at team building. I'm good at economics and betting on the processes of a business, repeatable business, et cetera. So I bring all this up because we decided, let's go join, instead of trying to compete with them, let's go join these teams and complement them, because real estate professionals are great at what they do, and that's often acquisition and asset management. And I live in the Bay Area, and I wasn't planning on moving back out of California. We had a beautiful decade in Colorado, of course, but I think beyond that, we have roots here. Our kids are happy here in school, et cetera. So let's go join these teams in the markets we love. And the markets we love are far away from where we're based. These places we started heavily in Dallas, Fort Worth, Texas, all the way across the Sun Belt East, so majority of our portfolio is in Texas, all the way over to, you got North Carolina, South Carolina, Georgia, and once in a while, more recently, we've found great opportunities closer to our neck of the woods, so we've done stuff in Boise, Idaho, Colorado Springs, Colorado, and Phoenix, Arizona, just to give some examples of, we just want high growth markets that provide cash flow for the investors. And you can't really find that as much in my neck of the woods. And so I said, well, we don't live in a we don't live in a deal state. We live in a money state. And it's not intended to offend any of the California real estate investors. It's just a different play. And so our investors are looking for cash flow, number one, and then growth, and then tax efficiency and tax benefits in that order typically. So it's a join them, don't try to go beat them. So we picked that strategy, and it served us incredibly well. So what I will do is just join GP teams, and they exist in their own. They can't go buy most of these buildings at their stage, without help from others, both on the equity capital, the investor capital, as well as I know, things like marketing infrastructure, I know business, any number of layers about business building and stuff. So we help out on those fronts, but primarily our core competency is bringing in investors that people actually want to work with. But we don't do that with a fund. I just join them in their GP team. I'm also registered with FINRA, and that's going to make zero sense to a lot of people. But for the capital nerds, the investing nerds out there, my brethren, they'll appreciate the fact that we did that in 2020. I registered with FINRA, and that's just a fancy way of saying voluntarily putting ourselves in a higher level of accountability and visibility, just like a person working at a bank would. I have to disclose everything. It means that I can legally raise capital on a fund without having a fund of our own, all that stuff. So I won't bore people, otherwise they're going to be asleep if I mention anything else about securities laws.
No, I appreciate that, because there is a level of scrutiny by registering with FINRA that probably most people aren't aware of. But it certainly will differentiate yourself, especially for anybody that is aware of or concerned about that, because I think there is a fair amount of I don't say fly by the seat of your pants, but there is guys that are more focused on just kind of the deal, as opposed to following all the rules and stuff, may not be as familiar with and or compliant.
Yeah, cowboy.
I'm not trying to put anybody down or up or anything, but I'm saying that there's the deal, and then there's also the regulations and stuff that come by it. And I appreciate you going that extra mile and doing that, and I'm sure your investors do too.
Yeah, I really appreciate you saying it, Darren. I mean, frankly, I think that you nailed it. I think fly by the seat of your pants is the nicest way, that very tactful way to say that. I'll take it a step further and just say it's Wild West out there. It's very Wild West out there. And I think that tends to be the case into a very, very heavy growth part of the cycle. And so I'm a black and white guy. I've always been that. I strive to operate on integrity, and I strive to be very forthright, because in the end, whether you're hiring an employee, you're bringing on a new investor, you're receiving capital ranging from 25K up to a potential $1 million check from a single investor for a single deal. I don't think they'd feel comfortable with that unless there was literally everything spelled out, and I wouldn't sleep well at night unless they were feeling comfortable going in on that too. And so I think there's a lot of folks comfortable taking those amounts of money for investment who are not doing things as rigorously. And I don't know how they're able to relax.
Well, I think probably the justification, if you will, is that by definition, you're dealing with either sophisticated or accredited investors.
Right.
So there's a level of scrutiny that's put more on the investor, as opposed to at a FINRA level, which is more of like a retail designation or a level of scrutiny kind of thing.
Yeah, well said.
And so the benefit of you taking it that seriously and doing that that level of certification or whatever the registration is that the investor or you were kind of bound by more rigorous disclosure kind of things, as opposed to somebody that's just saying, hey, if you can pass the test, if you have this much in assets or net worth, then it's up to you. Then you're sophisticated and how this works. So
that's right.
And so that's kind of the differentiation. But I think it's important, and I think it's to your benefit. And I'm certain that anybody that is looking at something you're presenting is probably able to differentiate the level that you're providing as opposed to one that's not. Whether or not they care, that's on them. But I would guess right. that anybody that is really kind of trying to tiptoe into this and trying to figure out what they're used to seeing and what they're seeing, there may be a gap versus what you're presenting might more reflect what they're used to seeing.
Yeah, I mean, I think you nailed it, and I appreciate you taking it there, because two comments that you made there, I think, are worth just replying to specifically, because they're so spot on, and you just don't hear it very often, Darren. Certainly in the private placement investing world, which just kind of is the official term to summarize this whole category, right? And I would just say that disclosure is everything. In this category, it's everything, because when you're putting in like this is, I'll speak personally from our own personal LP investing, limited partner investing, or with our own money. We've done at least half a dozen. I think actually the count was getting up closer to 8, maybe 9 that we've made personally this year, and that's passive investments that we made. And we just made the biggest one we've ever made And when that stuff happens, and you're sending out a wire to invest in these funds, they are predominantly illiquid, and so people are not going to be able to pull this out just because they start feeling like the market's giving them the heebie-jeebies. I look at that as a boon, like that's a good thing to me. And I understand that, could my money go away completely? Absolutely. That's why it has to be plastered on at least, like, I don't know, 12 to 15 times in writing for any one of our investors before they join. Is like, could your money go away? Yes. How many of our 37 deals has that happened? 0. So, that's why the returns can be what they are, is that it's not an FDIC insured savings account that has very low risk, hence a low return associated with it, but they're illiquid. And I think that that's part of the learning journey for any new investor, or even an experienced investor, is deciding in that moment, what is their risk tolerance for the more sweetened rewards. And disclosure is huge, making sure that you understand how experienced are these people that you met on the internet, potentially. And that's why we have this 5-part framework that we use at Madison Investing, that we just built for our own purposes, for our own money. It's track record, approach, the team, communications they use, and their values. And that's just one of 3 big buckets of the who, the where, and the business plan. Like this kind of I don't want to go too fast for folks, but that's really the framework that we use. I didn't come up with the highest version of that. Brilliant people came long before me, said, you got to go look at these deals and assess, the operator, the market, and the deal. And it's those 3 buckets. I like layman's terms to demystify this stuff for people and myself. It's like, it's really the who, who's managing the deal, who's working the deal, who's executing the deal, which is the single biggest risk for this category, full stop. The execution risk. Number 2 is the market. Are people going there, and are there jobs? That's kind of the big question mark. And number 3 is, what's the story for that deal? Like, what's the business plan? And then the number 1 thing I'll just say there, without going too long-winded here, is it's about repeatability, repeatable business process. And so it just, folks going in, if they're evaluating this, if they've never done it before, education is key. You don't have to do what I did with 24 books and 400 podcasts. That's not reasonable for any human being. I was a bit obsessed when I first got into the category. But I strongly encourage folks to just take their time and educate and start learning, because disclosure should be there if they're getting into these deals. And you should make sure you're comfortable putting that money away for a while, because it's not going to be something you can access unless there's hardship, and that's got to be a legitimate hardship. So sorry for the diatribe. I just wanted to arm some folks with the context.
No, I appreciate that. I think it all kind of helps round out the story there. So it makes sense here. So we've talked a little bit about kind of your model. You're raising money. You're investing with others. I'm curious, and you kind of alluded to the who and the where and the story. What are some key things that you've found when you're or that you look for when you're trying to determine whether or not a particular syndicator is someone that you're going to invest with?
Yeah, I think I have the benefit of looking at so many deals and syndicators, aka the sponsor, aka the operator. The terminology in the space is always confusing to me and others, so I try to demystify that by saying that's all the same thing. If you hear me say syndicator, operator, asset manager, and I know you know this, Darren, but maybe some of the listeners are hearing those distinctions for the first time. So if you were to put, I like assigning numbers to things because in business, it's just helpful, so this is not a scientific number I'm going to quote here. This is my rough estimate. If I am going and assessing how much of the right decision, making a good decision, whether it's yes, let's go, or a hell yes, let's go invest, because it should be a hell yes, it shouldn't be just a yes, or it's a no. And at least 80, probably 90% of the relative importance of that decision comes down to the who. And oftentimes the big mistake that you see so many first timers on these investments, and I get it, man, I was the same way. They go to what they know, and what they know is numbers. I would give a specific example of very common type of investor we work with. Brilliant, successful senior software engineers, dual income, making $400,000 each in a household, and they come in and they zero in on the numbers. And they zero in on, I want to review what's the proposed rental increase in years 1, 2, 3. And we're talking about a 20-tab spreadsheet that has probably 600 cells full of numbers. So they're picking one. Why is that a miss? Well, because in the end, spreadsheets, I love that quote you see floating out in memes out there on the internet of more stories have been told in Excel than PowerPoint throughout history. And that's absolutely possible within real estate. And so what I'm saying here is that people can make a story on numbers look very rosy. They're missing the point. The point is focus on the who. And the way that we do that is, number one, their track record. Have they done this before? And the business model is generally going to be find a high growth market. Like we like places like Phoenix, Arizona, closer to us, or you look at Atlanta, Georgia, Raleigh, North Carolina. These are places where there's job diversification. There's people moving there, population growth is forecasted to go up, et cetera. So you look at all that stuff, assuming that that's okay. Has this team, is there at least 2 to 3 of them, not one person? So there's a redundancy that's managing this team. Have they done it enough so that they have a process around it? Have they bought a building, let's say, pulled the 2 levers to do value add, because we primarily do value add deals, and that's renovations, new property management. So have they done that? Are the economics in that business showing profitability? Are they producing those beautiful cash flow deposits that come into direct deposit every month? And now we have dozens of these things ourselves that we've invested and worked really hard to get to over time. And investors that have invested with us 10 or more times now over years, 7 figures and up, and they're getting these checks every month. So by the time that all happens, and at the very end, they have to sell this property. The operators have to sell this property. I bring all that detail up to give people some meat behind that answer so that they can understand they need to have done all that. At least the team needs to have done all that at least one time. We much prefer and typically do expect more than that. But I would say as a starting point, we do like working with newer teams. And why? Because they're hungry. They often find deals that big, well-established 3-cycle operators out there. I know that some folks only invest with folks who have gone through 1 to 2 real estate cycles, and I respect that. Fact of the matter is, people with a $2 billion portfolio of real estate who have been through that many battles don't need your money. So they won't ask, and you won't get access even if you do. So the fact of the matter is, there's great deals right in between that are life-changing. And so we really try to find and partner with those types of teams because it's a win-win for all parties, for the investors that want to participate on a risk-adjusted basis, as well as really the team that is looking to bring on great investors that might want to come back and work with them again. So that's a lot to process, Darren. I mean, and that's literally why I think our business exists, is it's just, we help with that entire process by just curating and vetting down to the teams first with their own money and vetting those guys, and then coming back down to look at the deal by deal basis. So, I mean, the one more thing I was going to share briefly was just saying that, I think if you look at one of the interesting learnings I did not expect is that there's this notion of failure response. It's a term that I just started using years ago in my corporate career when hiring for frontline folks, all the way up to directors, VPs, and above. And that was, is this team, I will ask this team, I will ask this of teams now when we were vetting them, is like, have they been through, I want them to tell me and walk me through a really challenging experience, like challenging to the core, ideally in a real estate deal that didn't go well. And when they got figuratively kicked in the teeth, not to be too violent there, I'll just say that, what did they learn from it? And like, how did they put those learnings into the actual business processes and the mandate of their business? Because if they haven't been through pain and all they've known is comfort and winning, I certainly don't want my capital invested with that team, because I have no idea how much grit they have. I don't know how they are able to make decisions when they're holding 5 to 6 digits of my invested capital and they're at the steering wheel, are they going to have rash decision making because they can't take the heat? So I appreciate you indulging me on that answer. I wanted to give some teeth behind a couple insights.
No, I think that, given your position, and anybody that's looking to invest with you would want to know, how, some of the criteria you look for. And I concur the who. It's really easy to make the numbers look real sexy and all that, but upon execution and over time, are you, what's the likelihood of that happening? And then I think the who probably answers that more directly than just the pro forma kind of thing. So I appreciate that. So let me kind of go back to the topic that I introduced here, and just kind of make sure we're hitting on this. I introduced it as like playing financial offense versus defense.
Yeah.
And we know we're recording this in September of 22. It's probably not going to air until like November, but the point that I think is worth mentioning and worth asking and getting your input on is just, the economic conditions are in flux.
Yes.
Interest rates have risen, and the Fed is committed to pushing those even higher in an effort to break inflation. At the same time, there's a demand for housing. Investors are looking for real estate as an alternative to what they're finding elsewhere. And so there's, the market is in flux. And my question to you, and I'm sure the listeners would appreciate, is kind of hearing your take on, offense versus defense with real estate as we go forward.
I mean, it's clearly a fun topic, legitimately, to me, Darren. I think there's no right answer to what is going to happen, because no one knows. Not, as much as I devour and you read, like, not just listen to podcasts, but read reports, look at financials, look at forecasts from the brilliant minds way smarter than me out there trying to predict and understand what's occurring. But I stick to what I know and how I interpret things and read whatever I can. And I see 8.52% inflation as of the end of July. I don't think I'm not cool enough to know the August numbers. But I think you look at that, and to give context, I think most people are right now in 2022, as of this recording, looking at volatility and reading the headlines and kind of filled with a sense of dread, the same way that I was in, more like the 2009, 2008 time period, right? I was earlier in my career, but I had, a job, I had a career that was burgeoning and all that stuff. So I was paying attention as much as the average person probably. And that's while I was working at a financial tech company that's one of the oldest ones that does a third of the country's tax filings every year. I'm talking about Intuit, and they make QuickBooks and TurboTax, et cetera. So you'd think I was really getting it, and I was dumping money into 401ks. So I bring that up because if you just read the headlines, people are sitting there thinking, oh man, good time invest or bad time invest. And that is such a dangerous headspace to stop at. You don't want to stop at that level of curiosity. And I certainly did at that time. I maxed out my 401k, not a bad idea. Coming into this year 2022, I believe in the following things. I believe that people should always be investing. I believe that we will always be investing. I also believe, as a number 2 principle, that, there's no such thing as a time when there's no deals. There's just fewer of them, and they're harder to find. Brilliant person recently said, as a kind of a third principle that I've integrated into our lives, is like, well, there's no such thing as bad assets. There's just bad prices. So, these are guiding principles that I bring up, but to make it more tactical and useful for people, I'll just say 8.52% inflation. What does that mean? That means that our dollars, my $1 that I might have in my possession, if it's not invested in something, it's dying. I think that, if I were to use the language from Gary Keller's book, Millionaire Real Estate Investor, which is not the newest one, but I really appreciate the amount of clarity it brings to this topic. He uses this notion of like dead money, safe money, wealthy and healthy money, and the return rates associated with those things go up over time. And right now, not only is my dollar dying to inflation if I don't do anything with it, I mean, it is rapidly losing value in the real world to buy things that, such as food, such as gasoline. I know everyone already knows that, unfortunately, all these things. And so what changed? Well, the Fed's raising those rates, not the same rate as a mortgage rate. Used to think that in 2008 as well, before I went down this learning curve, of course, but mortgage rates are going up. And I encourage folks to go take a look at financial offense in this context, what it really means, Darren, to me and our family, before we apply it over to businesses and, deals. Are we sitting there adding income streams to our household? There's multiple ways to do that. I'm not dogmatic about it. Someone could invest in a real estate syndication, as we do with our capital and help investors do. They could also go do that in a fund. They can do that in a number of ways, but does someone have a clear set goal on investing for income streams to build financial offense? So some of our investors want more swagger walking into their corporate job because they want to make a really cool new cutting edge proposal and they know the boss isn't going to like it. So another $5,000 in passive income coming in monthly over time absolutely helps with that swagger. A lot of other folks just want to pivot out of their career, start a side hustle as part of the Great Resignation. That's definitely accelerated. Other folks, maybe at the other end, they're basically going out and at the end of a 30-year business they've built themselves, trying to get out passively, moving their real estate portfolio or their business into something that'll support them through their retirement golden years all the way through, and so that's the financial offense, is just going out there and saying, I'm not going to sit around and wait for our money just to somehow magically take care of our lives. We want to build passive income, and we want to do stuff that'll grow and exceed the inflation rate. It has to. Otherwise, money's dying. On the defense, that's a comment on two things. It's really a matter of, number one, can't really escape the notion of frugality. I don't believe in, in giving up coffee. I'm just not that guy. I love my coffee. I'm not giving it up. I do believe in driving used cars. We've had used cars for years. We lived in our first home for 9 years and well outgrew it years before that. We just don't need to keep up with the Joneses as a principle. We don't care about that. We like experiences, want to be great parents, want to help those around us and help and lead our business effectively. The real comment for financial defense would just be massive light bulb learning for folks out there, and for myself, certainly in our own journey. I was making great W-2 income, and roughly half of that was going to the federal and state tax. And that's something that I thought was fixed in life. And that is not the case. I realized over time, I can go add these income streams and we can keep more of what we actually make, as long as we're doing it, adding income streams that are more tax efficient. And, I don't look back fondly on the number of checks that I saw where I was like, oh, there's that fixed amount of money going over to taxes again and again and again, every paycheck and then every tax season. We don't celebrate tax refunds in this household anymore. Because if that's mind blowing for some folks, you're probably in the same place I was at the beginning of the journey. Your tax dollars could otherwise be, in the meantime, before you pay that bill, invested in something that's growing and outpacing inflation right now. And so that's the type of stuff, financial offense and financial defense, that we are very focused on and trying to encourage and helping others navigate that path, because it's scary. It is scary, and I get it, but don't let that stop you. I think folks will benefit from a very loving, well-intended kick in the butt to go take action on that front.
No, I appreciate that. I think, the offense and the defense, definitely keep learning, and offense, kind of the financial security that's the goal, is to have some sort of, cash flow that makes everything else, less important, as far as like critical to your ability to live in a way that you'd like. I dig it. Hey, I'm curious, the investors that you're working with, is there an ideal or kind of like a sweet spot that you found for somebody that you work with, that and I'm talking about people that are investing in your deals or in your fund. Can you kind of identify what that investor or that person looks like?
Yeah, and I think it runs the gamut. now, where folks are truly all over the country, all the way, from East Coast, West Coast. But it started out in my own network, as it tends to. So we have a very strong representation of technology professionals, on the business side, whether it's, business leaders like executives, maybe, and then on the tech side, you've got more product managers, software engineers, all the rest. I would say that that's kind of if you were to call it a profile of our ideal customer profile, ICP. Number one is people that are working full time, but making very strong income, and they don't need to invest to live a great life financially, take care of those who love them. So those folks are generally investing for cash flow first. The other profile, we did add a second one a couple of years ago, because now we have quite a few investors, and this is accelerating even just this week. We brought in a new one just yesterday. We have really entrepreneurs, like multi-decade, multi-generation entrepreneurs. And so these folks have done incredibly well. I mean, whether it's a wholesale business owner of 19 years that I got to know yesterday. We have a very seasoned repeat investor of ours who's more in the metal recycling business, third generation. Like that is interesting, because the purposes for this, and every person in between that you can imagine, whether we have multiple military folks, a pilot a jet technician who's just smarter than I can even fathom. He fixes jets and flies them to make sure they work. He's a kind of a hero in my book. That said, that other profile, they don't need cash flow to live. They've won. They pulled it off. They fought their battles. They built an incredible business. They're selling that thing, or they're offloading a real estate portfolio they built over decades. They just want to have killer tax benefits and have some diversification away from their other holdings, typically, because they also usually have a really sizable equities or stock portfolio. And so those are kind of the two that we do our best to go out of our way to serve with educational content to supplement the deals that they invest in with us. And those deals that we present, they're ones that typically align to those goals.
Got it. I appreciate you sharing that. I'm curious if when you meet a prospective investor, are most of them already warmed up to the idea of real estate, or is there a learning curve and kind of a resistance, or is there a time to become educated or does it take a while for them to become educated, willing, and wanting to invest with you?
Gosh, I mean, that's a really good question. I would say that many folks in our shoes, in comparable businesses, because I would say that they try to create content that starts someone all the way from basic zero, right? From no awareness of real estate. And fact of the matter is, I don't think in 2022, it's wise for any person as a prospective investor or even a consumer of a product. If you're going to go buy, like I just caved in and finally bought a new guitar that I wanted for a long time recently as a hobby. I researched the heck out of that thing, because the internet's a wonderful place in that regard. It's weird in some others, but it provides you all the information you need. So I didn't have to talk to a human before I paid more for a guitar than I'd ever think I'd be able to or want to invest. And on an investment like this, there's just some work people got to do. I don't want them to jump in not understanding. Not only is that irresponsible on my part, no one's going to sleep well at night if they jump in dropping $50,000 into an investment they don't understand. So we do provide educational content that's robust. However, it's up to the investor if they want to actually read any of it or watch a video or throw me questions, and I will field those questions any day of the week. I have actually a backlog of emails from last night and this morning, just from folks that have been reading our newsletters, and now they've kind of, I'm using, this is not their words, they're mine. They said, hey, I'd really like to kind of just ask you some more specific questions. I've been watching the videos and reading your newsletters and understanding stuff for a while now, but are there any additional resources? I'm just going to send the guy a quick recording and ask him if he wants to set up a call. He certainly can. That's the level of insight that I think most folks really cherish, that they cannot find easily, is soundboarding with another passive investor who's actually done a lot of these themselves. And that's really the value that we try to provide, because anyone out there can now go Google and just say, what is a syndication? What is a fund? What's passive income? And there's going to be 8,000 different resources. And so That area is well covered. But we are launching for the first time ever in 2 weeks, actually. So perhaps, this is in September. So by late September, we're launching a very cool new resource. I am so fired up about it and long awaited. And it's a blueprint for passive investing. It's free. People can come to our website at madisoninvesting.com and basically come in and download that. And so that'll be out in just a couple weeks.
Awesome. Hey, Spencer, if we could, I'd like to shift gears here for a second.
Yeah.
As I've mentioned, and we've talked a little bit, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies that we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be clients, investors, tenants, the market, interest rates, politics, however you would like to frame the question and identify what you consider to be the biggest risk. And again, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Spencer Hilligoss, what is the biggest risk?
My goodness. I love that question. And I say, my goodness, because it is such an intelligent question. And I wish that wish I can go back in time yet again and tell myself that every decision in life is a risk decision without exaggeration. And you already know the sport far better than I do because of your experiences, which is amazing. And I respect so much, Darren. Walk out the front door, you're making a risk decision. Drive your car, you're making a risk decision. What is the biggest risk? I think the biggest risk, as ethereal as this sounds, and I'm happy to drill down and make it less ethereal and make it more pragmatic or useful for people if they'd like, but this is genuinely what I believe. I think that the biggest risk posed to most people in life right now is a lack of curiosity. And what I mean by that is a lack of curiosity about their sources, like we're talking financially, of course. I would say they're not curious about how they make money and what does their money do? Like when they work for it, they know that. They know what their income is, they know that. They aren't really curious about, well, does this have to be the way that I do this? I'm curious, am I human as a professional capable of doing a different thing? Can I go do a side hustle? If I don't have any money, could I be capable of generating a capital engine, fancy way of saying simply a way to build more investable capital outside my day job, which is where most wealth is built. It's not in people's salaries. People don't build their net worth in their day job. They build their net worth by going out and building a business, by going out and investing, by going out and doing something on nights and weekends, it runs the gamut. And there's so many wonderful ways to go do that are free to start with and educate on now. Like college courses, sure. I'm talking pragmatic stuff. And so I encourage people to find a curiosity. And that includes, I thought taxes were boring. I don't think they're always fun, but I certainly think they're pretty fun now compared to many years ago. And most people would hear that statement and think I'm absolutely crazy. And that's fine. But get curious about your money and get curious about what you're capable of if you are not happy with your circumstances, or if you don't have a plan B, C, D, E, F to insulate yourself against the other many risks in the world. And so maybe, I don't know if that's necessarily barking up the completely wrong tree in the wrong forest altogether, Darren, but that's what I would chalk up if I had to give a single answer to what's the biggest risk, is a lack of curiosity and people just sitting there to do the same thing over and over. Working hard truly is not working smart.
No, I think there's a lot to that, what you said, lack of curiosity. And I certainly fall victim to that on occasion. It's easy to, do what you did because you know how to do it, kind of thing. but you also know what the results are you're going to get. And, if that's all you want, maybe that's, maybe there's, maybe you're fulfilled. But I think that it's part of the human condition to be curious. And, to have a rich life, there's got to be some curiosity and some effort put to learning something new, trying something new, doing something different. And who knows? You might find something you hate, but you might find something you really really like more than what you already know. So I
Well
applaud
said.
that. But hey, Spencer, before we wrap up here, where can the listeners go if they'd like to learn more or connect with you?
Yeah, this has been a pleasure. Thank you, Darren. Really thoughtful questions too, right? So our website, best place to find us, madisoninvesting.com, and that's Madison Investing with an ing.com at the end. On there, folks can go, and we got some content that's just educational available, blogs, etc. But also, folks can sign up for our monthly newsletter. It ain't fluff. It's useful. I do write those along with Jennifer, and we put a lot of work into them, but we are launching this new resource of passive investing blueprint that's from our own journey, and after speaking with hundreds and hundreds of very successful and new and experienced passive investors. So that's the best way to reach out. If folks are on LinkedIn, I'm also on LinkedIn. Yeah, thank you so much, Darren. This has been a blast.
No, I've thoroughly enjoyed it myself, and I learned a lot here, and look forward to doing it again.
Likewise, thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.